Okay, guys, this week we're gonna talk about topic 6, which is corporate financing. So we're gonna talk about in general how companies raise the financing, and then for our next topic, we're gonna talk about the capital structure of the firm. So this graph shows the patterns of corporate financing for U.S. firms from 1991 to 2013. So obviously, you can see from the uh, graph that the most of the firm that most of the financing they come from internal funds, and then that issues also account for that issue is also politics, right? So firms also choose debt issues. But if you look at the net equity issues, so equity issues, net equity issues, which is that is the difference between the share buyback and the share issuance, you can see it's negative. So meaning that firms usually do not actually issue shares, right? So it's essentially the issuance minus the buyback, right? So that if it's negative, that means firms normally they would do buyback instead of issuing shares, right? So this is what they do. And typically corporations they invest in long-term assets and in net working capital. So what is net working capital? It's current assets minus current liability. So this is what usually most of the firms do. And from the graph, you can see most of the cash is generated internally. So you can see because the internal generated cash accounts for a higher, and because firm need to invest in long-term assets and in net working capital, they need to seek outside financing. So, and from the graph, we can see most of the cash is generating internally. And then the net issues were negative in almost every year, meaning that firms engage in buyback more than share issuance. But in contrast, that issue were positive in almost every year, right? So you can see there were, so, so that seems to suggest the firms like cash issuance, firm like to use the internally generated cash in the first place, and then they move on to debt, right? And then the equity issuance seemed to be the least favored option for firms. So this is an important point, and we're gonna talk about this again later in like in like the in like next topic and also the topic after next topic, which is the firm's preferences over different financing choices. So the question seems to be, we observe that firms use lots of internally generated cash. So the question is, do firms rely too much on internal funds? So when we ask this question, we need to realize that external financing does not come without any cost, right? External financing entails stricter monitoring, right? I mean, if you borrow from a bank, if you raise equity financing from your shareholder, you are faced with stricter monitoring because this is shareholders' money, this is debt holders' money, right? They have to make sure that you're gonna pay them back on time. If it's about shareholder, then they need to make sure that they receive a fair return on the money they lend to you. Right? So that's why external finance entails stricter monitoring. There's also cost associated with issuing new security. So for example, you have to hire an investment bank that acts as underwriter for your security issuance, right? Then you need to pay them commission, right, in order for them to help you issue the new security. And also, the announcement of a new equity issue is also usually bad news for investors. And we will talk about this later in this chapter, but keep it in mind because the market reaction is usually negative for new equity issue. That is also why managers are reluctant to issue equity to raise financing. So this graph shows the borrowing of uh, the manufacturing corporations in the United States. And this balance sheet shows the aggregate current asset, current liability, fixed asset, long-term debt, right? We can see from this table that the long-term debt ratio is 0.34, which is 2014 divided by 2014 plus this shareholders' equity. That's why, so that's how you get this long-term debt ratio. And this ratio doesn't seem to be very low, right? I mean, 30% is debt, right? So, but when we talk about debt ratio, we need to realize that there is pros and cons associated with high and low debt ratio. If the debt ratio is too high, that means you rely too much on the debt, right? If you rely too much on the debt, one thing that could happen is that maybe in the future you won't be able to pay back the debt that you borrow, right? So which can cause financial distress, right? So that is a severe problem. But I mean, if you have a really low debt ratio, that's also not very optimal, because later when we talk about capital structure, one of the advantage of borrowing from your banks, borrowing from debt holder, is that you can have a lower net income. Sorry, you can have a lower tax burden. Right? So because the taxable income takes into account the interest payments, right? So the interest payment have to be deducted. So that means your before tax income will be lower if you have a higher tax burden, right? And then sorry, if you have a higher leverage or higher debt ratio, everything else equal, your before tax income will be lower, right? So in that case, that means the tax burden, if you have a high leverage, high debt ratio, will be much lower, right? So that means you have to pay lower tax. So this is one kind of advantage or benefit of borrowing, right? So if your debt ratio is too low, you're also gonna miss that kind of opportunity. Now we move on to talk about common stock, right? So common stock, I mean, if you raise financing through issuing new security, then it's the shareholder, which are the holders of your common stock, are gonna kind of sell their shares to you. Yeah. So what is common stock? Common stock is held directly by individual investors. Some of the company, they are held directly by individual investors, but a greater proportion belongs to financial intermediaries, such as mutual funds, pension funds, and insurance companies. And then in US, almost 50% of the common stock is held by financial intermediaries, and mutual funds hold 25%, pension funds hold another 15%, right? And suppose a company is financed solely by common stock and owned by the firm's CEO, right? So in that case, CEO receives all the cash flows and makes all investment operating decisions, right? So this is like CEO is the insider. Insider has this ownership, right? So this is, I mean, on one hand, this is good because, I mean, because we know that a very common problem with the modern corporation is the separation of control and management, right? So that means shareholders, they control the company, but they don't get to manage the company. CEOs, they are managers of the company, but they don't usually own lots of the firm shares, right? So this is the separation of these two roles, right? Which can cause the problem that CEOs, because they don't own the firm, because their personal welfare that did not depend on the firm's value. So one of the consequences could be that CEOs, they don't care about the firm, right? Because they don't, I mean, their personal wealth is not tied up to the firm. So if you have CEOs own the firm, which means if the company is financed solely by common stock and owned by the firm CEO, then firm CEO's incentive is very strong, right? Because I mean, they own a company, so that means their personal wealth depend on the firm's value. So in that case, CEO receives all the cash flows and makes all investment operating decision. And she also has complete cash flow rights and also complete control rights. So what that means is that because CEO owns the firm, right? So that means it has the complete control rights. I mean, she owns 100%. She also has cash flow rights. Also, it's because CEO does not borrow from other parties, other debt holders, right? That's why he also has complete cash flow rights, right? And these rights are split up and reallocated as long as the firm borrows money from debt holder. So, for example, when a company borrows from a bank, right, and there will be a bank loan. So, in a bank loan, the bank gets a privileged but limited right to cash flows. And the residual cash flow rights are left with the shareholder on the firm's assets and the cash flows, right? So, this is the allocation of rights. And in terms of the common stock holdings, right? In US, households hold 36.7% of the company's equities, right? And then mutual funds hold another 25%, right? And insurance company holds 6.1%. Pension funds hold 14.6%. So this is the common stock ownership. And this paper by Clifford and Holderness finds that 96% of the sample of US public corporations, they have block holders, right? Block holders are those shareholders with at least 5% of the outstanding shares, right? So that means US usually there are large shareholders that are called like block holders, right? They hold more than 5% of outstanding shares. And the bank typically protects the claim. What is the claim? The claim is the claim to the company's cash flow in order to pay back the debt, right? The bank typically protects the claim by imposing restrictions on firms' behavior, right? For example, they will try to design provisions that limit the future borrowing or forbid a firm to sell off assets to pay excessive dividends, right? And also shareholders, they retain the residual rights of control over investment operating decisions. So when a firm fails to make the promised payments to the bank, it might be forced to bankruptcy, right? And then once the firm is bankrupted, shareholders' cash flow and the control rights are restricted. So later when we talk about the bankruptcy rules, so when a firm is bankrupted, then the creditors, the debt holders have the first priority on the assets of the firm, right? So you need to first pay the debt holder, the creditors, and then shareholders gets the residual ones, meaning that shareholders have to wait until all the creditors, the debt holders are paid off, right? And how about shareholder rights, right? So in practice, shareholder control is limited to an entitlement to vote on issues like appointments to the directors and the major corporate decisions such as merger acquisition. Right? And in general, in US, there are two kinds of boards, unitary boards and classified board. So unitary board is the case where the entire board of directors comes up for re-election each year. Right? And what are classified boards? In classified boards or staggered boards, only a third of the directors come up for re-election each year, right? So in general, if you have a staggered board, it is very difficult for shareholders to replace the board. And in recent years, we see lots of firms, lots of shareholders, they're pushing to declassify the boards because it entrenches the directors and the manager, right? Because if it's difficult to replace the board, that means even if the directors are performing poorly, you cannot replace them, right? That is not good. So in general, people find that these actions to declassify the board increases firm value. But in some cases, classified board could be beneficial, right? For example, for innovation firms, for firms that do lots of innovation, staggered board could be beneficial because innovation is a very long run process, right? I mean, if the shareholder, they're very myopic, meaning that they really care about short-term performance, right? Then if you have a non-staggerable unitary board, it will be very easy for them to replace the director just because they're not satisfied with the short-term performance. Right? That is not good. So in that case, then it could be beneficial, right? So it could be beneficial to have a staggered bar, meaning that it will be very difficult for myopic shareholders to replace the directors. Right? So in that case, managers have more control, right? Meaning, and then that will make sure that long-term innovation projects deliver. So this is pros and cons of the staggered votes. And shareholder rights are also reflected in voting director elections. So before 2006, most director elections, they used plurality voting. Plurality voting means that as long as one director gets one vote, then he's automatically elected. So in plurality voting, you only need to compare. So you only need to look at how many votes this particular candidate get. You don't have to compare the number of votes for the candidate versus the number of votes against the candidate. You only count the votes that for the candidate, right? And I mean, in an ideal setting, maybe you have two candidates, then you compare the number of votes, 4 votes across these two candidates, and then the guy with the highest number of votes for the candidate gets elected, right? So that's the usual case. But in reality, in most cases, there are no competing candidates. There's no contested in other words, right? I mean, in many cases, one director, I mean, they don't have any candidate. So in our case, this plurality voting is just like a very like toy mechanism. It doesn't make any difference, doesn't make any sense, right? But then after 2006, there is a trend towards adopting majority voting, which means when you try to make sure that you get elected, you need to make sure that you get more votes that approve you than the votes against you. Right? So this is majority voting. You have to get more than 50% of the votes in order to get reelected. Right? And also, shareholders have voting power on significant matters like merger acquisition. So in that case, in many cases, there will be a supermajority voting rule. So which means as long as the shareholder votes across 70% of the total votes, then this issue is approved. And there are also dual class shares, right, that try to weaken the rights of the shareholders. So some firms have 2 classes of shares, like Google, right? So these 2 classes of shares differ in their right to vote, and also, of course, in terms of dividend. So one class of the share is held by insiders, by managers, right? They have greater voting power, but they have less rights to receive dividends, right? But the other class of the share, they are designed to allocate to shareholder. Shareholder, they have much weaker voting right, but they do receive high dividends. Right? So, for example, when Google made its first issue of common stock, the founders, they were reluctant to give up control of the company, right? That's why they created 2 classes of the share. The A class of share, they sold to the public. They only had 1 vote each, but the B shares, they had 10 votes each, right? So this is to prevent like myopic shareholders to vote against the management, to replace the board of directors so easily when the short-term performance or innovation is not satisfactory. Right? Because we know that innovation is sometimes very long-term risky, right? You need to tolerate for short-term failures. And basically, a holder of a block of voting shares might be able to obtain a seat on the board of directors or access to perquisites provided by the company, right? So then these shares might have extra bargaining power in acquisition. So when they are held by another company, the company can use the voting power and influence to secure a business advantage. Right? So now you can see if you have the A class share, if you have the B class share, you are very powerful to kind of approve or disapprove of significant corporations. So that's why this can also lead to managerial entrenchment. Right? So if shareholders find something is wrong, find that the manager are not maximizing their value, they could vote against the manager, right? So, but if they are in a dual class share firms and then they receive the A class share, their voting power is significantly weakened, so that they can all effectively kind of remove the director, remove the CEO. And there's also equity issued by partnerships. So the partnership units will be just like the shares in an ordinary corporation. They share in the profits and receive cash distribution like dividends, right? And then partnerships avoid corporate income tax. So any profits or losses, they're passed straight through to the partner's tax returns. So the limitations of those partnerships is the partnerships usually have limited lives, and a corporation, on the other hand, as an independent legal person that can and often does outlive all its original shareholders. So this is the limitation. There's also equity issued by trusts. So what is a trust? The trust is the passive owner of the single asset, meaning that they have the right to a share of the revenues from operating business. Right? So like real estate investment trust. And for example, this real estate investment trust, they were created to facilitate the public investment in commercial real estate. Right? And then these REIT shares, they're traded just like common stocks, right? And the rates are not taxed as long as they distributed at least 95% of the earnings to the REITs owners, right? So in that case, owners have to pay tax on dividends, right? Another kind of stock, a common or equity, is called preferred stock, right? So this is different from the common stock that we just talked about. So preferred stock provides only a small part of most companies' cash needs, right? But it can be a useful method of financing in mergers and certain other special situations. Right? So like that, preferred stock, they offer a series of fixed payments to the investor. And most issues of preferred stocks, they are known as cumulative preferred stock, right? So meaning that the firm have to pay all past preferred dividends before common shareholders are paid. So they have priority in receiving the dividends, right? And if the company misses the preferred dividend, the preferred shareholders generally gain some voting rights. And now let's move on to debt holder, right? So debt holders, they have first claim on the cash flows, but the claim is limited, right? So they don't have so I mean, for example, debt holder, they don't receive dividends, right? They only receive the debt interest payments. So that's why they don't have residual cash flow rights. And then debt holders, they do not participate in the upsides of the businesses, right? I mean, they don't say whether to take the project or not, right? And debt offers no control rights unless the firm defaults or violates debt covenants. So this is, we will talk about next topic, which is when a firm defaults. Like I said, the creditors and the debt holders, they have the control rights, right? They need, because their debt has not yet been paid off, right? They have to receive the interest payments first. And that's why debt holders have no voting rights. So this graph shows the holdings of bonds issued in the US by the US and the foreign corporation, right? So this is the holdings of bonds issued. You can see most of them, they are held by the insurance company, right? And also rest of the world, right? So like foreign corporation. And households hold 8.2%, mutual funds hold 23.1%, right? And insurance company, they will own the largest stake of the bonds, because insurance company, they're typically long-run oriented, and they do prefer regular payments of the bonds, right? They don't pursue risky investment. That's why they hold the largest stake of the bonds. And there's also other type of debt security, for example, long-term and short-term debt security, right? Depending on the project horizon and the repayment horizon. And there's also different bonds that they differ in terms of fixed rate and floating rate, right? Some bonds, they pay coupon, their coupon rate is a fixed rate, like 10%, 8%, right? And other bonds, they have a floating rate. Their coupon rate is floating, meaning that, for example, the market interest rate plus 5%, right? So this is like a floating rate bond. And also there's currency bond, like Euro bond, right? Euro bond is a debt instrument denominated in a currency other than the home currency of the market where it is issued, right? And also they differ in terms of the promises made to the lenders, right? So some investors, they demand the debt as senior debt, not junior subordinated debt, right? And the senior debt gets paid in the first place, right? And junior follows, and the subordinated debt follows from that, right? And there's also secured debt with collateral in place. This is safer debt, right? So that means you will have a collateral there to kind of make sure that the borrower of the debt pays on time, right? This is like mortgage loan, right? And also bonds, there could be straight bonds, there could be convertible bonds, right? So convertible bonds gives the owner the option to exchange the bond for a predetermined number of shares, right? The reason is that the owners hope that the share price will go up in the future, right? And there's also other debt security, right? For example, accounts payable, right? Lease of equipment, pension obligation. So in some industry, lease of the equipment is actually, you can think about that as a hidden debt, right? Because you need, this is like you lease airplane, right? And then you need to pay lease payments every month, right? So you can think about that as a hidden debt. So in the financial market, there's flow of savings to investment. So for example, in the financial market, there are different markets in the first place, right? Stock markets, fixed income markets, money markets, and the markets for commodity, derivative, etc. Right? And then there's the financial intermediaries like banks, insurance companies, mutual funds, and the pension funds. And what these financial intermediaries do is that they get deposits, they get investment from investors worldwide, right? And of course, investor, they can directly invest in the financial market on their own, right? You can open an account and invest in US market on your own. You don't have to go through a financial intermediary, right? So if you do invest through financial intermediary, then the financial intermediary will lend the money to those corporations, and these corporations, they invest in real assets, right? So they will constantly reinvest, right? And then they also raise financing from the financial market, like stock market, fixed income market, if the firm wants to raise equity or debt, right? So for example, the Bank of America raised 300 million by the new share of shares, right? And then there's an Italian investor who buys 6,000 of the new shares for $10 per share. Now, Bank of America takes that 60,000 along with money raised by the rest of the issue, and it makes a 300 million loan to the ExxonMobil, right? So in that case, the Italian investors' savings end up flowing through the stock market to a financial intermediary like Bank of America. And then the financial intermediary lends the money to ExxonMobil. And what is the financial market? The financial market is a market where financial assets are issued and traded, right? So there's a primary market, there's a secondary market. In the primary market, firms, they issue new shares, right? For example, a totally new company goes on IPO in this primary market, right? So, and for example, Bank of America used the financial market to raise money from investors by a new issue of shares. And also there could be seeding offering, which is the issuance of the additional security from an established company. And for this established company, their security already trades in the secondary market. Right? And in this secondary market, usually investors they trade among themselves. And what is a financial intermediary? Financial intermediary is an organization that raises money from investors and provides financing for individuals, companies, and other organizations. And banks, insurance companies, and investment funds, they're all intermediaries. And financial intermediaries, they raise money by taking deposits or selling insurance company, the insurance policy. If the financial intermediary we're talking about is insurance company, right? So they do so by selling insurance policy. And then they invest the money in financial assets, for example, in stocks, bonds, and loans to businesses or individuals, right? They lend money to corporations or individuals. So this is the financial assets of intermediaries in the United States. You can see the biggest goes to pension funds, and then the next is banks and saving institution. Mutual funds is the third one. Right? Insurance company is the next one. So now let's talk about different intermediaries. So mutual funds, right? What are mutual funds? Mutual funds, they raise money by selling shares to investors, and then the money is then pooled and invested in a portfolio security. So they manage portfolio. And then investors in a mutual fund, they can increase their stake in a fund's portfolio by buying additional shares, or they can sell their shares back to the funds if they wish to cash out. And the purchase and the sale prices depend on the fund's net asset value on the day of purchase or redemption. So if a mutual fund has net inflow, that means that that means the investors they want to buy more stocks and bonds, right? So then if there's a net outflow, that means the mutual fund needs to raise more money, right? Because the fund outflows dominate the fund inflows. Right? The more investors who are pulling out of the funds. And most of the mutual funds, they invest in shares or in a mixture of shares and bonds, right? And money market funds invest only in short-term safe security like treasury bills. But treasury bills is quite short-term, right? Because the maximum maturity for like treasury bills, it's like 1 year, right? They're usually 6 months. And they're usually for individual and small and medium-sized businesses, right? Because it's quite safe. And mutual funds, they're open-ended funds, which means that they stand ready to issue new shares and to buy back existing shares, right? In contrast, you can have a closed-end fund, right? In a closed-end fund, it has a fixed number of shares that are traded on the exchange. So if you want to invest in a closed-end fund, you cannot buy new shares from the fund. You must buy existing shares from another shareholder of the fund, right? Because the number of shares, they are fixed. So then we have another type of fund, which is called ETF, right? Exchange traded fund. So what are the differences, right? So the big difference is that if you're a mutual fund manager, you still have discretion in rebalancing your portfolio, right? Meaning that you can buy and sell some of your stocks. Right? But for ETF, it's more passive, right? You just mimic, let's say, S&P 500 index, right? You just mimic Russell 3000 index, right? And the commonality there is that you can achieve low-cost diversification by holding shares of the common stock or by buying ETF, right? So basically, ETF is basically a mutual fund that invests in all the stocks in a stock market index, right? So this is like ETF, right? You can have a S&P 500 ETF, you can have Shanghai Stock Exchange ETF, right? So that will be almost mimicking the index, right? And then ETFs are in some way more efficient than the mutual funds because there's no managerial discretion, right? So sometimes managers make mistakes, but ETF avoid such mistakes because there's no manager there, almost no manager. And then ETF portfolios that are tied down to indexes or fixed baskets of security, and the prices track prices of indices. And what about hedge funds? This is another intermediary. Hedge funds investment strategy is very different from mutual funds because they have higher incentive, right? So hedge funds investment strategy, they are more complex. So therefore, they are accessible by only knowledgeable investors such as pension funds, endowment fund, and wealthy individual. And because they are very complex strategy, and that's why they guarantee very high return. And in order to compensate those talented managers that deliver a superior return, they also, hedge fund managers, they receive higher performance fee, like 20%. So hedge funds, they're set up as a limited partnership. So what are the investment strategies of hedge funds, right? They typically identify overvalued stocks or markets, and then they sell them short. Right? So some hedge funds, they take bets on firms involved in the merger negotiations, and other hedge funds, they look for mispricing of convertible bonds and take position in currency and interest rates, right? They look for mispricing, and they profit from that mispricing. And hedge fund managers, they manage less money than mutual funds, but they sometimes take very large positions and have a large impact on the market because they need to deliver superior return. That's why they need to take a lot of risk. Right? And merger, so another strategy they usually use is called merger arbitrage, right? Basically, the merger arbitrage is when they simultaneously buy and sell the stocks of two merging companies. So in a cash merger, which means the consideration is all cash. So acquirer pays all cash to the target. In our case, one can buy the stock of a target company and then make a profit if and when an acquisition goes through, right? So in our case, the hedge fund who actually hold the stocks of the target company, they can use this strategy to profit. Right? And also in a stock for stock merger, the merger arbitrager or hedge fund manager, they can buy the stock of a target company while shorting the stock of the acquiring company. Usually in a stock for stock merger, target company stock price increases while the acquiring company stock prices goes down. So when a merger is complete, the target company stock is converted into the bidding company stock, and then a merger arbitrager, in our case hedge funds, it will simply use the converted stock to cover the short position. Right? And later we'll talk about another strategy, which is called hedge fund activism. Right? So this is an innovative form of shareholder activism, right? Because hedge fund activists, they directly influence the management of the company. And what they do is that they first identify undervalued firms, find out the weakness, and then launch a campaign to influence or replace the top manager. Or they will suggest what action the firm manager should do to maximize shareholder value, to improve shareholder value. And finally, when activist value-enhancing strategy are implemented, activists, they will exit from firms and make profits. And finally, pension funds, right? Pension funds, they're usually, their funding usually come from employees, right? Employees' pension contributions. And the contribution come from all participating employees, right? And then these contributions, they're pooled and invested in securities or mutual funds, right? And then each employee's balance in the plan grows over the years as contributions continue and the investment income accumulates. The balance in the plan can be used to finance living expenses after retirement, right? So this is what pension contributions are used for. And the amounts available for the retirement depends on the accumulated contribution and then the return, right? So the pension fund manages the pension contributions, right? Hoping that these pension contributions will accumulate value over time. And also the contributions, they are tax deductible, and the investment returns inside a plan are not taxed until cash is finally withdrawn. Right? So this is the advantage. Now we move on to talk about different financial institutions. Financial institutions, they raise financing in very special way, right? For example, by accepting deposits. So this is like commercial banks. They also can raise financing through selling insurance policy, like insurance company, right? You can also provide additional financial services, right? Like investment banks. For example, they can provide services in the merger acquisition, in the issuance of new security or issuance of seasoned security. And for commercial banks, they provide a major source of loans for corporation, right? And also commercial banks, they take deposits from investors. For investment banks, they advise and assist the companies in raising financing. So for example, they underwrite stock holdings, right? So what they do essentially is they buy new shares from the issuing company and then resell the shares to investors, right? Also, they provide advices in takeovers and acquisitions. So, and also they offer investment advice and manage portfolios for individual and institutional investors. They also run trading desk for foreign exchange, commodities, bonds, options, and derivatives. Right? And investment banks, they can invest their own money in startups as well, right? Provide financing to those startup technology firms, right? And the largest investment banks we are talking about here is Goldman Sachs, Morgan Stanley, Lazard, and Nomura, and Macquarie Bank. These are the largest investment banks. And insurance company, they are also a financial institution, right? What they do is that they typically sell insurance policy. And they're actually more important than banks for long-term financing of businesses because they are quite long-run oriented, right? Because when they issue insurance policy, that's typically 10 year, 20 year, 30 year. Huh? That's why the nature of their business is more longer term. So they are massive investors in corporate stocks and bonds, and they also make long-term loans directly to corporation. So what they do is that they kind of sell policies to the investors, and then they lend to companies, right? So again, they are like borrow and lend. So a company can directly issue a bond to investors or negotiate a long-term loan with an insurance company. This is how a company can raise finance. So there are different roles the financial markets and intermediaries play. The major role here is to provide financing for businesses and to channel savings to real investment. There's also other roles like payment mechanism, borrowing and lending, consumption timing, pooling risk, allocation of risk, and information. Right? So for example, borrowing and lending, right? So that's basically providing financing for personal finance, right? If you want to buy a car, you borrow money from financial institutions, typically from the bank, right? And there are sufficiently many depositors with different savings horizons, right? And then financial intermediaries to facilitate the match between the lender and the borrower. This is one role. And also consumption timing, right? So financial market, they help store wealth in financial assets, right? If you buy a product from the shadow banking, or if you buy a stock, you hope that in the future the stock price will go up, right? In that case, you are trying to store wealth in the financial markets, right? And you're trying to shift your purchasing power from high earnings to low earnings periods of life, right? For example, after you retire, right? So that's why you want to invest in the financial market, right? So in high earnings period, you invest. In the low earnings period, you sell in order to finance your compensation in the low earnings period. And financial markets also help allocate risk, right? Financial markets allow investors with different taste for risk to bear that kind of risk. So for example, if Toyota raises the funds to build an auto plant by selling both stocks and bonds, then they cater to different investors with different risk preferences, right? The more optimistic and risk-tolerant investor, they buy stock. The risk-averse one, they buy bonds. So, and also the information role. The information role is try to tell try to tell the company that wants to raise financing whether it's good timing or not. Right? So the stock prices and the company values summarizes the investors' collective assessment of the company and its future. So if you see the stock price is not performing well, that's probably not a good time to raise equity funding. So then I will briefly talk about the financial crisis of 2007, 2009. So we all know this crisis, right? That's the crash of the financial market, which comes from the subprime mortgage crisis, right? So which means those subprime mortgages cannot be paid off, right? Which causes large defaults. But the financial crisis had its roots in the easy money policies of Fed, right? Because at that time there's a large amount of hot money in Asian economies, right? They were invested back in the U.S. debt security, right? And then they pushed down the interest rates, right? And then banks took advantage of this cheap money to expand the supply of those bad quality mortgages to low-income borrowers with poor credit profiles. And the widespread availability of mortgage finance fueled a dramatic increase in house prices, right? So, I mean, but we know that at the end of the day, the house prices will go down. So when the house prices go down, crisis become. So on one hand, the Federal Reserve's policy of reducing the interest rates have resulted in low yields, right? So that means investors, they are eager for high yielding investment, right? So they're eager for high return. On the other hand, the low volatility and optimism about the future encourage risk-taking behavior, right? Especially for this high-yielding investment. So, and another change that facilitates the occurrence of financial crisis is there is a change in the housing finance, right? So, in other words, the securitization of mortgage loans, right? So this is another kind of root cause for financial crisis. The original model is originate to hold, which means there's a local thrift institution like banks, right? They make mortgage loans to homeowners. And banks, they have persistent portfolio of long-term mortgage loans, and the main liability is deposits. But before the financial crisis, there are significant changes to this business model, right? The biggest change is called securitization. So basically, mortgage loans that are packaged into mortgage-backed security, asset-backed security to sell to investor. So in that case, many mortgage loans, right, even with low like credit worthiness, right, with very low credit score, they are packed into security and sold to investor, right? And Fannie Mac, they bought mortgage loans and bundled them to large pools, right? And mortgage-backed security, they are tradable claims against the underlying mortgage pool. Right? So this is and then the key risk here is that as long as the underlying mortgage are defaulted, then the mortgage-backed security broke down, right? Because this is, I mean, investors buy the mortgage-backed security in order to receive those payments, right? But if the underlying mortgage broke down, then the mortgage-backed security will be worthless. So this is the original to distributed model, right? So originating mortgage brokers, they had little incentive to perform DD, right? So this is the kind of the new model that we're talking about, right? So initially, before the financial crisis, there's this pool called a private label pool. So private label pool is usually the pool of mortgage loans with very high likelihood to default. Right? In other words, bad mortgages. Right? So in that case, investors in this mortgage pool, in this private label pool, will bear the default risk. And originating mortgage brokers, they have little incentive to perform due diligence. So in our case, investors, they can only rely on the credit score And then there's a strong trend toward low documentation, no documentation loans, right? So that that increases the riskiness or increases the risk investors are taking by buying those mortgage-backed security. Again, this mortgage-backed security, they are tied up with the underlying mortgage. As long as people cannot pay back the mortgage, the mortgage-backed security broke down. So this is the originate to distribute model. So essentially you have a homeowner, the other investor. So the originator is the local bank. The agency is the federal Fannie Mac, the Freddie Mac, right? So then essentially homeowner still borrows from the originator, right? And then the um, originator is responsible for collecting the mortgage payments by the homeowner, right? And then they return the mortgage payments to agency, right? Agency pays those homeowner the servicing fee, right? And then agency typically sells those mortgage-backed security to the investor, right? So now you can see essentially investors are giving money or lending money to the homeowner, which they don't actually know, right? And then in many cases, those mortgage borrowers, they have very poor credit score. So that's why it's very risky, right? So as long as the homeowner cannot pay back, the investors, they are screwed up as well. So this is the original to distribute model. This is the securitization of the mortgage loans. So this is the cash flow in this model, which you can take a look. Okay? And then this is basically the seed for this financial crisis, right? This transforming model to sell the mortgage-backed security to investors that causes financial crisis, right? Because when the subprime mortgage loan cannot be paid off, right? That means any mortgage-backed security that has that kind of subprime mortgage will break down, right? So which causes losses for many, many investors. Right? Now we're gonna talk about how corporations issue security, right? And there are typically four ways, right? We're gonna typically talk about four parts: the venture capital, initial public offering, season issue, and the private placement. So initial public offering and the season issue, they are for public firms. Private placement, they are actually for private firms. Right? So we start from venture capital. So what is a venture capital? Venture capital is basically a form of private equity financing. Right? They're actually private equity. And this private equity financing is provided by venture capital firms or funds to those startups, right? Or like early stage emerging company. And venture capital firms or funds, they invest in these early stage companies in exchange for equity or ownership stake in those companies, right? And of course, those venture capitalists, they take the risk, right? They take the risk of financing risky startups in the hopes that some of the firms they support will become successful. Right? Typically, they will have like 20 to 30 firms, right? Maybe 29 of 30 firms fail, right? But as long as one company succeeded, then it will be enough to cover the losses. So that would be the idea. So that's why VC investment, because they invest in those startups, risky startups, that's why they have a high rate of failure. And usually venture capital startups, they have different rounds of financing, right? So they start from seed funding, right? So which is the earliest round of financing. And it is supposed to prove a new idea, and it is often provided by angel investor. And so there's also another way to do that seed funding, which is equity crowdfunding, right? Which is usually conducted online, right? Then startup round. Startup round is where the early stage firms that need funding for expenses associated with marketing and product development. Right? And then we go to growth rounds, right? Growth round, it's like Series A rounds, right? So this is to raise financing for early sales and manufacturing funds, right? And it is also the first institutional rounds, right? And then subsequent investment rounds are called Series B, C, and so on. Right? And after that, we have the second round of financing, which is to raise financing for the working capital for these early stage companies. These companies, they are selling a product but not yet turning a profit, right? And next, there could be expansion round, which is mezzanine financing, right? So this is trying to raise expansion money for a newly profitable company. You know? So between these rounds, there could be bridge financing as well, right? So I mean, between the startup and the growth, you might be, I mean, so maybe something bad happens, right? You are eager to search for additional financing, right? So then there could be bridge financing organized by an VC in between those ones. So the incentive structure of a startup firm is very different from a typical private company or like public company. So basically, the private company, the startup, sells the shares to VC and the VC buys the shares, right? And then in exchange, the entrepreneur gave up half of the company and accepted VC representatives to the board, right? And then management has to accept modest salary, and then they could cash in only from appreciation of the stock, right? This is to incentivize the startup of the manager of the startup try to make sure their company delivers value as soon as possible. And if the company failed, they will get nothing because VC bought preferred stock that convert automatically into common stock when and if the company goes IPO or get generated stable earnings. So this is for the startup managers. And if the company failed, the VC will be the first to claim any salvageable assets, right? So they are like the debt holder in some way, right? And then the VC firm will want to say in how the business is run, right? So that's why they will need to demand representation on them. And finally, if there's an IPO or an acquisition happening, meaning the startup goes on IPO or is acquired by another company, VC can access through secondary sale. Right? And early stage VCs, they might exit in later rounds when the new investors buy the shares of existing investors. So sometimes the company very close to an IPO, they might allow some VCs to exit, and instead new investors may come in hoping to profit from the IPO. Right? So this is an IPO situation. And this graph shows the volume financing, the scale of financing for Uber. Right? So you can see they go from initial seed round to series A, B, C, D, E, and G. Right? The funding size keeps on increasing. And the valuation, of course, after every round, the valuation of Uber also increases dramatically over time. So this is the VC. In this venture capital market, the most venture capital funds, they're organized as limited private partnerships with a fixed life of 10 years, right? And pension funds and other investors, they are limited partners, right? They are limited partners in this VC fund. And then there's a management company, which is called general partner, who is responsible for making and overseeing the investments and receive a fixed fee and a share of the profits, which is called a carried interest. And also there's also private equity sometimes joining in this VC, right? So that's why this is the structure of the venture capital. And venture capitalists tend to specialize in young high-tech firms that are very difficult to value, and they monitor these firms closely. Right? They also provide advices and also help them make connections with other kind of directors or managers in other high-tech companies. And venture capitalists, they might cash in on their investment in two ways, right? One is like we just talked about, right? IPO, right? And then acquisition, right? So when a new company establishes a record, it might be sold to another large company. This is also another way when venture capitalists exit. So this is the investments, the value of the investment made by venture capitalists in US. Right? And basically in the 15 years to June 2014, right? Across all these years, they have earned an average annual return of 13% after expenses. Right? So, and then this is 9% more than the benchmark. The benchmark is the SP 500, right? So if you invest in the SP 500 index, you might get 5%. And now let's take a break and then we will continue to talk about initial public offering. Okay, next we're going to talk about initial public offering. So initial public offering essentially means that the new shares are sold to raise additional cash for the company. So this is like when a company first go onto the public market to raise financing. In contrast, secondary offering means that there's already established company there, and the company has already raised the financing before, but existing shareholders, they decide to cash in by selling part of their holdings, right? So they want to issue new shares to raise additional financing. So many IPOs, they're actually a mixture of primary and secondary offering. For example, for the 2014 Alibaba's IPO, it raised a record of 25 million, but actually about a third of the shares, they were actually sold by the company, but the remainder was sold by existing shareholders. So you can do a mixture of primary offering and a secondary offering, but in most cases, firms either do a primary offering where they first go on the market and raise financing, or they do a secondary offering, which is by existing shareholders to cash in by selling part of their holdings. This is the initial public offering. And then here is a chart that shows the motivations for going public. The most frequent one is to create public shares for using future acquisition. So that was for the purpose of acquiring other company. And second is that to establish a market price for the firm. Next, to enhance the reputation of the company, to broaden the base of ownership, to allow one of a more principal to diversify personal holdings to minimize cost of capital. So these are all motivations for going public, but there are of course benefits of going public. For example, you can raise financing, right? Now you have access to the public market. The scale of financing that is available to you on the public market is definitely much larger than the financing that you can have if you stay private. So this is one of the advantage. And of course, the cost of capital is also could be lower, right? So because when you are a private company and you borrow from the bank, the default probability that a bank sees is definitely different from default probability that a bank sees for a public company. So, and also as a public company, you have other ways to raise financing. You have other types of debt security, and you have other types of equity to kind of help you raise financing. So these are the motivation for going public. And in general, firms have two different ways. If you're a private firm, you can raise financing through private placement, which we'll talk about at the end of the chapter. The advantage is, of course, you don't have to disclose everything, because if you go on public and raise financing, then you have to disclose every single detail of your business, right? You also need to disclose the financial statement, right? So this is the cost of disclosure. In other words, it's the proprietary cost of information you have to bear if you go on public to raise financing. But the disadvantage is that the shares are less liquid because they are a private firm. Now, the good thing is that if you're a public firm, the public offering, they are marketed by underwriters. So you can do initial public offering and seed equity offering. The scale of financing is much larger, right? And then registration must be filed with the SEC. So here are some examples of the SEC prospectus. So basically, when a firm does the IPO, it has to register with the SEC, right? So how do you register with the SEC? You have to file a prospectus, which is called IPO prospectus, to show or what you're doing, right? What is the nature of businesses? And why do you want to raise financing? So, and what is the preliminary offer price you're thinking about? So this is a IPO prospectus for Alibaba, right? So you can see in this IPO prospectus, it has a description of the purpose of the initial public offering, right? And also risk factors, right? And the nature of businesses, right? What kind of businesses Alibaba does, right? And the revenue, the cost, and the cash flow, all these information, right? So this is a kind of catalog, right? So businesses, regulation, dividend policy, so everything you need to tell the investor about this company, right? So this is the IPO prospectus. And basically in IPO, if you want to do it in US, and similarly, if you want to do it in China, basically you need to first appoint managing underwriter or book runner and co-managers. And then in that case, there's an underwriting syndicate will be formed. So managing underwriter will be the leading investment bank, right? And there will be a couple, if you're a big company, there will be a couple more investment banks that are in charge of underwriting the security. And arrangement with the underwriter will typically include like compensation for the investment bank. So typically it's 7% for medium-sized IPO, it's a commission. And there's also agreement on greenshoe option. So this greenshoe option allows the underwriter to increase the number of shares bought by 15%, right? And you need to register issue with SEC, and you need to issue a preliminary prospectus. And after these prospectus are approved, you need to organize a roadshow. So roadshow, it's like a public relation or advertising event where the manager and the writer needs to build a book of potential demand. So basically, the investment banks, they need to know what is the potential demand of this stock for this company stock, right? And what is the appropriate offer price they need to set, right? So then SEC approves registration, company underwriters agree on issue price, and then underwriters, they will allocate a stock, right? And sell the stock to the other institutional investor who actually want to buy a certain number of shares. And then trading starts, underwriters cover the short position by buying stock in the market or by exercising greenshoe option. So basically, they will start buying the stock in the market. And then managing underwriter, the leading investment banker, will make liquid marketing stock and provides research coverage. So this is the typical process, of IPO. So in this case, the underwriting arrangement is between a company and the underwriting syndicate. So basically in this underwriting syndicate, the bankers purchase the security from the issuing company and then resell to the public. And then the issuing firms sell the security to the underwriting syndicate, and for the offering price, less a spread. So because you have to pay the spread for these underwriting syndicates in order for them to help you to market a stock. And once the SEC has commented on the registration statement and you issue the prospectus to the interested investor, then bankers will organize roadshows to publicize the offering. So why do you need a roadshow, right? You need a roadshow because you don't know what is the appropriate offer price, right? Maybe there's little demand, there's little interest in this stock. Then you don't want to price the stock in a very high price, right? So the roadshows will generate interest among potential investors and then provide information about the offering. And then also they will provide information to the issuing firm, right, about investors' enthusiasm, investors' interest in the stock, right? And tell them about what price is appropriate. And this process is called book building. The process of gauging the demand or estimating the potential price. This process is called book building. So basically, the large investors will communicate an interest in purchasing shares of the IPO to the underwriter. And then these indications of interest are called a book. And the process of polling potential investors is called book building. So you're like building the book. Book is like the amount of the investor. And then the book provides valuable information to the issuing firm because institutional investors often will have useful insights about the market demands for security, also for the firm. So this is very important because, I mean, again, this tells you how much you want to issue, right? And also what price do you want to offer. And based on the book building, based on the potential demand, potential interest from the institutional investor, bankers frequently revise the initial estimate offering price, right? And also the number of shares, of course. A very famous phenomenon in IPO is called IPO underpricing. So this is referring to the case where usually the first day return of an IPO stock is usually positive and it's very large, right? Which suggests that the offer price that the underwriter set are kind of undervalued, are kind of lower than the intrinsic value of the company, right? So of course, there are some other cases where IPOs are overpriced, like Facebook, right? But in general, on average, we find that there is an IPO underpricing. So an IPO underpricing is very high in US and also higher in Asia, but relatively low in Europe. Right? So this is IPO in US. That's about, so this is the number IPO. And then this is the right one is the average first day return. So you can see average first day return, it's about 10 to 20%, right? Which is pretty high, right? So 10 to 20%. In China, it's even higher. You can see the scale, it's already changed. So the first day return, it's about 200%, right? The IPO first day return. Well, of course, I need to remind you that the reason why China's IPO underpricing on the first day it's significantly higher, it's because in China, in order to get an IPO approved, there's a rule of thumb. That is your PE ratio, meaning that the offer price cannot exceed a certain threshold. So I think it's about 23 to 26. That is the maximum PE ratio you can advertise your stock. So that's why, because there's a manual or automatic threshold there. That's why on the first day, the IPO underpricing is significantly much higher. Yeah? But anyway, that's a general phenomenon, right? IPO underpricing. But what is the reason for this IPO underpricing, right? So there are many advantages of pricing the IPO stock at a lower price. For example, a low offering price on IPO raises the price when it is subsequently traded on the market and enhances the firm's ability to raise further capital. Right? So an uninformed investor who cannot distinguish which issues are attractive are exposed to the winner's curse. So winner's curse means that you typically overpay for an object that is intrinsically worthless. Okay? But then companies and underwriters, they are aware of this and they need to underprice on average to attract informed investors. The central idea here is that, I mean, you need to build a book, right? You need to know the potential interest from the institutional investor, but that's not enough, right? You cannot rely on the institutional investor to buy all of your shares. I mean, because finally it's the retail investor that will buy also a substantial fraction of your shares, right? So that's why you need to encourage the retail investor to buy the stock as well, right? But then how do you encourage them to buy, right? If they buy and they lose, they don't want to buy the stock, right? So that's why the only way to attract retail investors to buy the shares of your company is to set the price at the lower level such that they all make profits on the first day. Okay? And that's why underwriting is in the interest of the underwriter, right? The other reason is that they want to reduce the risk that they will be left with unwanted stock. Okay? And another explanation of an IPO underpricing has something to do with asymmetric information. So because on this market, there are informed investor, which is like institutional investor. There are also a bunch of uninformed investor, like retail investor, right? But they don't bid according to the quality of the IPO, meaning that they don't buy the IPO stock according to the quality because they don't know the true quality of the IPO. So if you have a weak IPO, then there will be only uninformed investor bids, right? And then they lose money and leave the market. So that's a weak IPO. So why would uninformed investor lose money? Because uninformed investor, because if you offer a offer price that is higher, right, then most likely uninformed investor, they will if they buy the stock, they will most likely lose, right? So in that case, the underwriters need an informed investor to participate, right? So that's why you need to have the retail investor win on the first day, right? So that they have incentive to participate in this process of IPO. That's why underwriter repriced this IPO to bring in those investors and ensure that informed investors bids. Right? And when investment banks, they can allocate more shares to informed investor, the underwriting is reduced since the compensation, because now you no longer need to attract that many retail investors, right? So that's why you don't need to underprice it. So also, when the information about issuer is more freely available, the underpricing is also low, right? So in that case, an informed investor will be at less of a disadvantage, right? Because an informed investor, when they try to buy the stock of IPO, they are at a disadvantage, right? Because institutional investor, they know more about the stock, about the company. So that's why even if there's uncertainty in terms of whether the company is good or bad on the first day, right? So and then if the company is bad, then investors lose money, right? No, investors do not want to lose money on the first day, right? So that's why in order to encourage them to participate, to buy, you need to offer them first day positive return. And so the book building process is also for the underwriter to assess the amount, obtain price information, right? Like we just talked about, the book building process. So that's why underwriters need to, another reason here is that they need to underprice the stock in order to elicit the information from the investor. Right? For example, if the IPO's intrinsic value is $20 per share, right? If you price the offer price at $21 per share, now in that case, you don't know the true demand, right? Because it's higher than the intrinsic value. You don't know what price, you don't know the intrinsic value of the institutional investor. Right? So that's why if you price the IPO at the lower price, let's say 15 or 16, right? Now, in that case, you will encourage the bidding from the institutional investor. Right? This is to incentivize aggressive bidding by the institutional investor so that you know where the true or intrinsic value of the company is at. So, and it allows the underwriters to better gauge a higher sale price. So that's also one of the compensation for the underwriter, right? Because if the underwriter priced the stock at a lower price, and then finally there's a first day positive return, the prices goes up, then it is also easier for the underwriter to sell all of the shares to other investors. And finally, we're going to talk about security sales by public company. And public company, they can issue security either by offering to investors at a large or making a rights issue. The rights issue will be limited to existing shareholders only. Right? So there are two types of security sale. One is general cash offer, the other is rights sale. So in the general cash offer, it's similar to when a company first went public, right? You need to register the issue with SEC and it sells the security to the underwriter, and then the underwriter offers security to the public. Okay? And then again, there's a book building process. The underwriter will build up a book of likely demand for security. And because the registration process with SEC is very lengthy and cumbersome, there's an easy way to do the security sale, which is called shelf registration. So here, the large company are able to file a single registration statement covering financing plans for up to 3 years, right? So that means within the 3 years, you don't have to file registration again. You can just file this plan ahead of the issuance. So let's say you invite bids for 100 million of bonds, right? And then suppose that you perceive a window opportunity where the interests are temporarily low, right? This window opportunity will disappear quickly. So, and some bids may come from the largest investment banks and others come from ad hoc syndicates, right? So that's why in order to capture this very short-term window opportunity, you want to register in advance so that you don't miss the opportunity. But because the registration process is quite lengthy, it takes a couple of days, right? And maybe the window for this opportunity is only like a couple of days. So this is the advantage. So if you issue the shares using this general cash offer, right? There are costs associated with that, which is substantial administrative costs. So you need to compensate other underwriters by selling the securities below the price, and underwriters will need to profit from that, right? And then the underwriting spreads for spreads for equity issuance it's quite large, right? It's like 5 to 7%. Right? Of course, if you issue debt, that's a little bit lower, right? So it's lower than for common stocks. So for many issues, it's less than 1%. Okay? And large issues tend to have lower spreads than smaller issues. But always there's a cost of issuing the security. If you do a general cash offer, that is, you need to compensate the underwriter. So this table shows the gross underwriting spread for selected issues, right? So for Alibaba, it's 1.2%. And for, let's say, this company, Spark Energy, that's 7%. So because for this like energy stock, pharmaceutical company, it's difficult to sell the stock because the company has lots of proprietary information, lots of technology related knowledge that also investors do not necessarily know. And for debt issuance, it's typically much lower, right? So for Google, the underwriting spread is 0.45%. And in general, the announcement of the issue of the stock issuance results in a decline in the stock price. The decline is about 3 to 4%, and the price of the stock is simply depressed by the process of additional supply, right? So so this is like demand supply, right? If the supply is higher, the price is lower. And on the other hand, there's little sign that the extent of the price fall increases with the size of the stock issuance. Right? So a couple of explanations for this. So the simple explanation is that if the CFO is really optimistic about a restaurant's future, then she must think the company's stock price is too low, right? So now in that case, it will be very costly to raise financing by issue stocks at that point in time, right? So because if the investor sees, so if the CFO thinks that the company is undervalued, then she should not issue the company at that time, right? Because there will be many other companies that will issue the stocks when the stocks are overvalued. Right? You only issue stocks when it's overvalued, right? Because if you issue the stock when it's undervalued, it will be much costly, right? Suppose you want to raise $1 million financing, and then the current price is like $20 per share. And you know the price is too cheap, right? Now, the intrinsic price in the long run of the company might be $30 per share, right? So in that case, if the stock converges to the $30 per share, you only need to issue less shares, right? Than the number of shares you have to issue when the price is $20 per share, which is current market price. Right? So that's why you don't want to issue stocks when you think the company is undervalued, right? You only issue stocks when the company is overvalued. When a company is overvalued, that is a cheap deal for you, right? Because you have to issue less shares than the number of shares you have to issue when a company converges to its intrinsic value. Yeah. So in that case, if company is all, if investors all know this mentality from the manager of the company, then potentially the market will discount the issuance, right? Because they will interpret the issuance of the stock as a signal that the company is overvalued. Right? So that is, investors, they will predict and mark down the price of the stock accordingly when the equity issuance is announced, because investors know when you issue the stock, the company must be overpriced. Right? That is the mentality. And we will explain this in next topic. And this paper by Conan and Teheran examine a sample of stock issues by commercial banks and find support for this theory. So what they found is that some of these issues were necessary to meet capital standards. The rest were ordinary and voluntary stock issues designed to raise money for different purposes. So the necessary purpose issuance, right? Because this kind of issuance, it's not driven by the incentive to issue stock because it's overvalued, right? It's like the mandatory thing that you need to do, right? So in this case, this caused a much smaller drop in the stock prices, right? Because investors know that this is what you have to do, right? It's not that you want to take this opportunity, right, to dump to kind of raise overpriced the share, right? So raise financing from the overpriced issue, right? So, and most financial economists, we will interpret the stock price drop on equity issuance as information effect. So this information suggests that the company is overvalued, right? That's why investors adjust their valuation downwards. And if you talk about issuance of preferred stock or debt, the markdown effect is better, but they're still marked down. Right, so here, pessimistic managers, which means the manager think that the company's stock is overpriced, right? So the company's future is not so good. So in that case, to avoid this markdown, to avoid that investors know that the company is overvalued, they may be tempted to get a debt issuance, right? And then investors actually know that pessimistic manager has a greater incentive to issue equity rather than preferred stock or debt, right? Because if you think your company is really, really overvalued, then you have a stronger incentive to issue security. So that's why when a company announces the issue of preferred stock or debt, there is a little fall in the stock price. Right? And there's a remaining puzzle, which has something to do with the efficient market hypothesis. That is, we see that the long-run performance of a company that issues shares is substandard, right? So this, you can see, this is actually not like efficient market hypothesis, right? So if it's really about overpricing, right, then the market price will adjust it, right? Adjust it, then it's down, right? But it's not that, right? It suggests that firms that issue equity really has some problem with the long-run performance, right? It's not just that they're overpriced, right? Even if their prices are adjusted, the performance is also bad, right? So this is a puzzle that remains unsolved. So finally, we'll talk about right issues, right? So right issue is where the company gives the existing shareholder the right of first refusal, right? And these issues are known as the privileged subscription or rights issues, right? And these right issues are largely confined to the closed-end investment company. In Europe and Asia, right issues are very common, and in many countries, right issues are obligatory. Now, here's one example. So in 2011, this company offered its existing shareholder the right to buy 3 shares for every 20 that it currently held, right? And then the new shares were priced at at 13.93 each, right? And the current price is 24.93. Right? Now let's imagine that just right before the rights issue, you held 20 shares of the stock. So that would be 494.6. So. And this offer will give you the right to buy 3 new shares, right? Because 20, right? Every 20, you're gonna buy 3 new shares, right? That's 3 times 13.93. So because this is the price of the new shares, right? So this is 14.979, right? So now the total investment, the value is 494 plus 41, right? So you get this number, right? And then the value of, and then you have 23 shares, right? 20 shares plus the 3 new shares, right? Now the value of each share is gonna be 23.32. Now the value of the right is then 23.32 minus this, the value of the share, right? Which is 13.93, which gives you 9.39. So this is the value of the right. So remember, the value before and the value after should be the same. That's why we can use this equation. Now, the rest of the example you can read by yourself, right? So it's just asking a different number, right? So you can look at it by yourself. And finally, we're going to talk about the private placement for a little bit, right? So the company can avoid a costly process of registering with AC by selling the stocks privately, right? You can, but of course, that will be on a very small scale, right? You must be sold to no more than 35 knowledgeable investors, right? And the drawback here is that the investor cannot easily resell the security because there's no liquidity, right? There's only 35 investors out there, right? So, but there's a advantages that you don't have to disclose everything to the public. That is the advantage. And this is the SEC rule, right? So in 1990, the SEC adopted Rule 144.8, right? And this relaxed the restriction on who can buy and trade unregistered security, right? Then this rule allows large financial institutions to trade unregistered security among themselves, right? So, and this increases the liquidity. This was supposed to increase the liquidity, right? Because if it's just among the very small number of investors, then the liquidity is really bad, right? And this rule also reduces the interest rate and the issue cost for the private placement. Okay, this is what we're gonna talk about today.